Welcome to the InterMarket analysis video update. This is a video that I do once a week where we look outside of the S&P 500 at other sectors, other indexes, even other markets to see if we can get some clues as to what's happening ultimately with the S&P 500. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. If you watch these videos on a regular basis, there's only one change this week, and there are two small cap indexes that we follow. One is the S&P 600, the other one is the Russell 2000. The Russell 2000 generated a golden cross. Now the S&P 600 has not done that yet. When you get to the end of this video, I go through a list, and the only thing that's in a downtrend right now is the US dollar. And the dollar going down is actually helping stocks to go up. The stock market typically likes a weaker dollar because of the conversion rate and the exchange rates and the import-export relationships, especially with the trade deals and the tariffs that everybody's still trying to figure out what's going to happen with all that. So in what you would expect would be for the dollar to go up, but it's actually going down. Usually when a country becomes more defensive or treats their own assets as far as being more precious with these tariffs and things, you would think the dollar would go up, but it's actually been going down. Okay, so the first area that I'll go through is just valuation. And this hasn't changed for years, literally. We look historically, we look going forward, and the market's overvalued. But we've been overvalued for quite a long time. Then we look at growth versus value. No real changes there this week. We still see growth outperforming value in the bigger picture. And inflation, want to keep an eye on that. There's some areas that we watch just to see if they're adding some inflationary pressures to the market. And then we look at other markets like aluminum, corn, wheat, things like that. Then we look at the 11 S&P 500 sectors. We look at them, a chart all by itself, and then we do a ratio with how is it performing when compared to the S&P 500. Then we look at a number of different indexes just to see if we can get some insight there. We look at correlations between different markets and then some very long-term trends. These are using monthly charts and long-term oscillators and so forth. Then at the very end is where I go through a list of those things that are positive and negative right now. So valuation, we continue to be overvalued. We're above the red dashed line. We would have to come down to the 4,300 level, 4,330 or so, just to be considered expensive. And the current price of the S&P is well above that. But you can see, going back in time, we stay above that red dashed line for extended periods. This is that same thing, just going back to 1980 and different events that happened. Even when we had the dot-com bust, we were still overvalued, but then earnings were going down during that time. The only time we got kind of close was during the great financial crisis, and we got kind of close during the whole COVID crash and then ultimate rise up, and then we went into that bear market in 2022. So you can see this does adjust, and we look at a number of different charts, usually from other sources throughout the week, that pretty much tell us what we already know. I mean, the market's expensive, but the market can stay expensive and get even more expensive. This is another way of looking at the price to earnings ratio developed by Robert Schiller. His reading is coming in at 38.45. That's well above the median and mean, which we've seen for a number of years now, of between 16 and 17. Then this looks forward at the forward PE ratios. And this purple line, these are the mega cap 8 as defined by Edward Yardeni. Alphabet, that's Google, Amazon, Apple, Meta, Facebook, Microsoft, Netflix, Nvidia, and Tesla. And so we're getting up close to that 30 range. We're coming in at 29.7. We look at the S&P 500 forward-looking PE ratio, it's at 22:1. And this is pretty high, but it can still go higher than where it's been before. Back in 2020, we got well above the 22 level. Then we look at growth versus value. And I look at a number of different things. We look at short-term charts, we look at long-term charts, just to see, are we seeing confirmation in a number of different ways? We look at indexes, ETFs, and so forth. When you look at growth all by itself, it's in an uptrend, and it's well above both the moving averages. Now, the value index that we follow, it's also in an uptrend, but see how it's dancing along its 200-day moving average. So you can just tell by this that growth is outperforming value when you look at this first chart and then this chart. Then we do ratios, and this is where we get our insight from. This is showing how growth is outperforming value. Then this is an inverted version of that same chart, how value is underperforming growth. Then we look at the rest of these charts to say, okay, are we seeing the same thing through different measurements? ETF, growth versus value, doing really well there. The value is really underperforming the growth ETF. Another index showing how growth is outperforming value, how value is underperforming growth. Confirmation. Then we look at some ETFs, and we're actually breaking to the upside here. Some of the other indexes that we look at are not quite at highs yet, but this particular ratio that we look at here is breaking out to a new all-time high. And this is that same ratio, but showing how value is underperforming growth. Then we look at the small caps, just kind of going along sideways, but they're still in a longer-term uptrend. As we got out of the lows in April and into May, we saw the small cap, this ratio really doing well. But since that time, it's been going sideways, but it's holding on to its gains for now. Mid caps, seeing a little bit more of an upward move, even though the mid caps are lately underperforming the small caps. And we saw a bit of a drop back here in the latest reading with the S&P growth to value ratio, but it's still in a longer term uptrend. And we want to keep an eye on inflation. And this is a little bit concerning. If you look at the bottom, this is a monthly chart. This is a ratio between inflationary areas of the CRB index and deflationary areas, meaning that they're going down in value. And this is really starting to come up. We're seeing this longer term here. But when we look at the monthly chart on top of the CRB index, it's coming down to its longer term moving average. We look at a daily chart of the CRB index, also falling down below both moving averages now, but it's still seeing an uptrend where the 50-day is above the 200-day moving average. And we're in an uptrend with the Baltic Dry Index. This tries to look at inflation by how much does it cost to ship products in the Baltics. Inflation expectations were, when I did this video a week ago, we were actually dropping down. We'd just come off the heels of that weaker than expected employment report. Well, we saw this ticking up a little bit in the latest reading. And then we look at a ratio between inflation expectations and TIPS, Treasury Inflation Protected Securities. These are what folks get into because they adjust for interest rates. They're shorter term. And folks like that when interest rates are going up and inflation is going up. We've been coming down with this ratio overall, but it did tick up in the latest reading. Then here's some other markets that really we only look at in this video, at least I only look at them here, where we see aluminum is still in a downtrend. Corn is also in a downtrend. Wheat is in a downtrend. Fertilizer is starting to go up here. That could be a little bit inflationary. We've been watching this tick up as we get through 2025. Lumber is in an uptrend, but recently pulled back. It's not really breaking out the way it was back in 2020. And some of this is attributed to during the lockdowns, people were going to Home Depot and buying all this lumber and doing their home projects because they really couldn't do anything else. And so we saw lumber really going up. It's more stable now. It's still in an uptrend, but it's not really breaking out with any inflationary pressure right now. Oil is continuing to drop, and this is mainly geopolitical. We follow it for growth of the oil industry itself. But then oil also is heavily impacted by what's going on around the world, specifically in the Middle East. And we're coming down into the lower mid 60s now. And then we look at a gold to oil ratio. Gold's just been going sideways. Oil has actually been coming down a little bit, but we're seeing this ratio coming up, not because of strength in gold, but mainly because oil has been declining. Gas, which is still in an uptrend, but it's starting to fall below its moving averages. Then we look at oil and then a correlation with the 10-year yield. You can see where the dashed line has us going up and this is going down. This actually, the correlation should be going down because they're going in opposite directions. But right now, for the most part, when you look over the last 10 periods, they're having a tendency to go in the same direction. So oil could be going up and the 10-year yield could be going up, or vice versa. Heating oil, which is just barely hanging on to an uptrend here, but it's coming back down to its moving averages, which is strange in the summertime. And natural gas, which is also starting to see a downtrend now. Then diesel, again, this was really starting to go up, and that was causing us a little bit of concern. Now we see diesel starting to drop back. Then copper, now this, it's still in an uptrend, and this is something that the market uses as a barometer of the economy. And when copper's going up, okay, that's generally looking more positive for the economy going out into the future. Well, copper took a really big hit when some tariff news came out and it really fell. Now it's trying to bounce back up here a little bit, and that fall was so fast that we're still in a moving average, but we want to keep an eye on this one. And then the copper to gold ratio really took a hit too. And it's not like gold was going up, it's that copper tanked here. And this was really starting to improve with this ratio, and then it really dropped off. And then we look at a longer term chart here, and then I have one right after this to show you this, just to give it more context. We look at the 10-year yield and the 2-year yield, and then the copper to gold ratio. This is more, what do they think is going to happen with the economy? This is the one that's put out by Bloomberg. The copper to gold ratio sends downbeat message on the economy. Now, for months, I've been doing this video and talking about how copper's in an uptrend and that bodes well for the economy. But the big drop that we saw here, that's a little bit concerning. And you can see how we look at manufacturing. That's the ISM that came out. And there's a pretty strong correlation between things that are being built in the US and the copper to gold ratio, and that is starting to decline. And gold, as I said, is just pretty much chopping along sideways. This is the gold ETF. And then silver came all the way down to its 50-day moving average, and now it's starting to bounce up off of that. We look at a gold to silver ratio on top. When this is going up, that means gold is outperforming. When this is going down, that means silver's outperforming. And then we can compare that to the US dollar index. And this tries to measure the interplay between precious metals and currencies. And the correlation is starting to get stronger again. It had been going in opposite directions, and now we see this tending to move more hand in hand. And here's the dollar. It got back above its 50-day moving average, got all the way up to the 100 level, and then it's starting to decline, and it's just a little bit below its 50-day moving average again. Then the euro, which has really been going up against the dollar. This is compared to the dollar, which has really been going down. Then to put all three of the big world currencies on here, here's the Japanese yen, the euro, and the dollar. Then we break those out here. With the euro, it fell underneath its 50-day moving average, but now it's starting to come back above that. So the euro's going up against the dollar. The Japanese yen, it's still in an uptrend compared to the dollar, but you can see it's starting to trail off here and setting a series of higher highs and even lower high or lower lows here. So that might change in the near future, but it hasn't changed yet. And then the British pound, still underneath its 50-day moving average, still in an uptrend, though. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then different indexes. We look at a weighted version of the S&P, which is the S&P index itself. That's the bar chart. And that's been going up. Now, some might say this could be a bearish flag. I'm not big into patterns. We'll just have to see how this plays out, where we have a downward move and then we start to come back. I've been noticing the bar patterns of higher highs and higher lows, and that so far is looking fairly constructive. But you might make a case that, okay, we're coming back up, but we haven't been able to exceed above this previous high. This was set on Thursday a week ago, where we opened right at the high and then spent the day coming down, and then we gapped lower on Friday on the heels of the employment report. Is something going to happen here to actually make this go down at this point? Now that's the S&P itself, the weighted index. We look at the red line, which is the equal weight index, where all the stocks in the S&P are treated the same, and we're seeing a bit of a disconnect here. It's really the mega caps that have been driving the market higher, especially this past week. And we look at another ratio, how the equal weight is underperforming the weighted version of the S&P. Then we look at a stocks to commodities ratio, and stocks are outperforming, even though longer term we're a little bit concerned about that inflation to deflation ratio. This shows how commodities are underperforming stocks. And we look at the NASDAQ 100, which set an all-time high on Friday, and the S&P, which did not set an all-time high on Friday, but is close. And they're both doing really well right now, but the NASDAQ 100 is doing even better. The S&P 100 really breaking out. These are the biggest stocks that make up the S&P 500, and this ratio is continuing to go up, and that's a healthy sign for right now. The Nasdaq is also outperforming the S&P 500, and we're still seeing the Nasdaq 100 underperforming the Nasdaq, and that could be taken as more negative. It's like, I thought the mega caps were really driving things. Well, they did later in the week, this past week, but they haven't really assumed their major longer term leadership role, at least yet, if that's going to happen. You could take this as positive, saying, well, when the NASDAQ is outperforming the NASDAQ 100, that just means more stocks are participating. So there's a different types of interpretation that you can take with this. We look at the mega caps compared to the equal weight ratio, really breaking out to the upside as the mega caps have been outperforming. And small caps continue to underperform the S&P. This is another look at that same ratio. The red line is small caps to S&P ratio. The blue line is the S&P. And then small caps continue to underperform the tech sector. Mega cap growth looking pretty good here, setting a new all-time high in an uptrend as well. And the robotics and AI ETF, this is all the buzz. This is what everybody's all freaked out about. Now, if you look at this by itself, it's doing pretty well. It's above its rainbow and it's in an uptrend. But when you compare it on a sector basis with the tech sector, it's actually underperforming. Now, there's another ETF that I'll go through later that's actually performing better, but this one is actually underperforming. And then we look at the Dow Jones Composite, which is the Dow, the transports, and the utilities, still in an uptrend here. Didn't quite make it down to their 50-day moving average. And we're a little bit concerned about this. The semis, which have been underperforming tech, now they did bounce back. There was some positive news coming out about tariffs and things that the semiconductor index liked. It kind of fizzled out earlier in the week, but it's helping this ratio to come back up. But we want to see this really start to outperform. That's when we're more positive. Now, it doesn't always have to be that way. If you remember back to 2024, where we topped out, then we had a correction in July of 2024, and then we started to bounce up out of that. And the semiconductors underperformed pretty much for the rest of 2024. And the stock market was still going up, still making new all-time highs. We were seeing more broad participation. It just wasn't coming from the semis outperforming in the tech sector. All right, then low volatility, just kind of chopping along sideways here. This is defensive stocks here, and continuing to underperform when compared to the S&P. And we look at all world stocks, but we take out U.S. stocks, and these are pretty solid. And so global stocks are performing quite well when you don't include U.S. stocks. When you put U.S. stocks back into the mix, still doing okay, but in a downtrend, but you can see where it's underperforming. Energy sector is underperforming tech. Not a real surprise there. And growth is outperforming bonds. That's what you see in a more healthy environment. The tech sector is outperforming the 10-year yield. And then I have an inverted version here, how the 10-year yield is underperforming the tech sector. And this is not really breaking out to the upside. It's in an uptrend when we look at the discretionary to staples ratio. We would like this to do better. It's doing okay, but it's not really showing an awful lot of strength right now. This is that same ratio, but inverted, how staples are underperforming discretionary. Gold, and again, it's not that gold is outperforming, it's that the S&P has been going up here, and that's why we're seeing this ratio going down with the gold to S&P ratio. And then again, the same thing. The dollar's been going down, gold has been going sideways, and that's why this ratio is still staying pretty strong. Then we look at the advanced decline line. We're still looking pretty good here. We're above the moving average with the NYC common stock, the S&P 500. The mid, excuse me, the S&P 500, then the mid caps, where we're seeing a little bit more weakness, slightly below the moving average of the small caps. And we look at what's called traditional Dow theory. Now, real traditional Dow theory just looks at the Dow and the transports. I also include utilities in that mix, where we're not quite back to an all-time high. We've got a ways to go here with the Dow. The transports, which had been doing better, now they're starting to fall back. Where the strength is coming from are utilities. And as I mentioned, this could be considered a growth area because of all the electrical needs for AI and crypto mining and electric vehicles and so forth. But typically, this has been more of a defensive area. We look at a ratio between the Dow and the transports. When this is going up like it's doing lately here, that means the Dow is outperforming. The transports, which were looking better, now they're starting to fall back again. And then we do another ratio of the Dow transports to the S&P 500. This is showing how the transports are underperforming. And we do a correlation between the S&P 500 and the Dow transports. The correlation is still fairly strong. Even though the transports are underperforming, they have a tendency to go in the same direction at the same time. And then instead of using traditional Dow theory, this swaps out the Dow for the S&P 500, which is close to an all-time high. And instead of using the transports, we use the NASDAQ, which did set a new all-time high on Friday. So you can take that as positive because we're setting all-time highs here. You can take that as a little negative divergence because we set a new all-time high with the NASDAQ, but we didn't with the S&P 500. Now, if the S&P comes back and does set a new all-time high, that's going to negate that negative divergence. And then we break it down a little bit more. Instead of using the S&P, we use the S&P equal weight, which is not very close to an all-time high here. That's another negative divergence to be aware of. We're close to an all-time high with the S&P, but not here with the equal weight version. And we're not close to an all-time high with the equal weight version of the QQQs, which is the NASDAQ 100, which did set a new all-time high with the index on Friday. So this is also a little bit of a negative divergence, but it's kind of telling us what we already know, that it's a few stocks. Like Apple had a great week, up really, really strong this past week. And they're such a huge company that when they go up, that really helps the NASDAQ 100 to go up as well. The Wilshire 5000, not back to an all-time high yet. A little bit underperforming here, but it's still in a longer-term uptrend. The total U.S. stock ETF also has a ways to go to get back to an all-time high. The FANG index, now even though the really big stocks have been doing better, this is actually a closing high here. This is Facebook, Apple, Amazon, Netflix, Google, Nvidia, and so forth. They're still looking pretty solid. The NYSE composite still dealing a little bit above its 50-day moving average. Now, this has been holding up, and it's still in an uptrend, but this has been underperforming lately, which is a little bit of a concern as we just see a handful of stocks which are really driving the market higher. Then all stocks, which include U.S. and international stocks, it's not quite back to an all-time high here. And it's mainly being fueled by international stocks, not as much with the U.S. stocks. Then microcaps, which are in an uptrend, but they fell back almost to their 50-day moving average. They're a little bit above it currently. ARK is still in an uptrend and showing some improvement here. My understanding is that the ARK Innovation ETF owns a lot of Tesla. So if Tesla does better, ARK does better. Then high leverage loans still above the 50-day moving average, even though it was down a little bit on Friday. But this is another barometer that we use for the economy because these are very risky loans and they're just coming off of setting new all-time highs here and in a pretty solid uptrend. So this is giving us more confidence looking forward to the economy. Emerging markets are in an uptrend, looking a little bit more solid than U.S. stocks right now. And the Japanese Nikkei, it's above this red line. That's the all-time high that was set back in 1989. We've finally been able to break above that. But you can see over the last couple of years, we've just been mishmashed around here, around this red line. Bitcoin continues to be in an uptrend. It came down to its 50-day moving average and has been bouncing up off of that. And then here's the other ways that we look at semiconductors. The SMH semiconductor index, not at an all-time high here, but in an uptrend. And then this is starting to break out above the rainbow. This is the same ETF that I just showed, but it's a different way of looking at it, but it's not quite back to the all-time high. This is the other ETF, the AI and Tech ETF. It's not in an all-time high either, but it's in a more solid uptrend. And we look at the home builders, the S&P on top, the home builders in the middle, and we see that the correlation between the two is still fairly strong. So they're tending to go up or down more in tandem. Then I switched the names over here if you've watched these videos before. But we're actually in a downtrend. This is a long-term KST oscillator, but China's in a downtrend. Emerging markets are now in a downtrend according to this. We're in an uptrend in Europe. Japan is in a downtrend, and yes, we're in a downtrend here with the S&P. But this is very, very long term. All right, then we look at a monthly chart of a ratio between US and world stocks. We're still above this moving average, but you can see even with the up week, how it's coming down a little bit so far for the month of August. But longer term, it's still looking fairly positive here. We were starting to turn up with the PPO, but now we're leveling off. And we look at bonds versus stocks. This is the 7 to 10 year Treasury bond ETF. These are bonds based on price, where they really gapped up, and that means that interest rates were going down, but we've been just chopping sideways to slightly drifting lower since then. And we look at the total bond ETF. This is still in an uptrend and doing quite well there. The stock to bond ratio on a monthly basis shows that stocks continue to outperform. This shows on the daily side how bonds are underperforming stocks. The Praying World Bond Index is in an uptrend and really choppy over the last few years, but for right now, it's holding up better. The Dow Jones Corporate Bond Index is in an uptrend. And investment grade bonds, which are also corporate bonds, not back to its all-time high yet, but it is continuing to be in an uptrend. Then we look at junk bonds, and these are just coming off of setting recent all-time highs. We look at a stock to bond correlation, and as you would expect, they have a tendency to go in opposite directions. If stocks are going up, bonds are going down, and vice versa. Junk bonds coming off of recent all-time highs here. And then we do a ratio between junk bonds and more conservative government bonds. This is showing how junk bonds continue to outperform. We look at a ratio between junk bonds and more conservative bonds like government bonds, just chopping along sideways here for the last number of months with this overall ratio. 10-year Treasury yield showing how for 40 years we were seeing a series of lower highs and lower lows with interest rates. Then we went through the COVID crash. And now we've been establishing a higher range for interest rates, which really, even in the bigger picture, would be more the norm. And we do some stock to bond ratios. The S&P 500 to 1 to 3 year bonds. This is coming out up above the rainbow. And you're going to see a lot of the same things here no matter what we look at. Then here's the daily chart of yields, which had been coming down, but then over the last few sessions, they're starting to go back up. This is a weekly chart of global yields, and notice how we're coming down just a little bit here in Japan. Then we look at the volatility of bonds, which has been coming down, and the moving average is coming down, and then the volatility of stocks, which has also been coming down lately, and just coming out of neutral territory here when we look at the correlation between the volatility of bonds and the volatility of stocks. Then here's where you're going to see a lot of the same things again. The S&P 1500 to short-term bonds coming up out of the rainbow. Another broad market measure to 3 to 7 year bonds, not quite breaking out with as much conviction, but still in an uptrend. The tech sector doing well when compared to 3 to 7 year bonds. And then the S&P 500 compared to the 10-year Treasury yield, showing how the S&P 500 is outperforming. And then this shows how bonds are underperforming. And then a longer term chart here. This is a monthly chart of the long-term bond, which has been going sideways lately, but it's still below its moving average. And then we look at another ratio of the long-term bond to commodities, and the KST is still continuing to go down. Then we look at the different sectors. Materials, which just generated a golden cross, but then they're falling back and dealing with their 200-day moving average. Now, some of this weakness could be attributed to that weaker than expected employment report, because if there aren't as many jobs, there aren't as many materials that are being used to build things. And it's continuing to underperform when compared to the S&P. Communication, a growth area, which has been going sideways here for the last few months, but it's still in an uptrend. And kind of dropping down a little bit here when we do a ratio between the communication sector and the S&P. We want to keep an eye on that one. Energy, which is in a downtrend, and it goes to the upside when things get weird geopolitically, and then it tends to drop back. but continuing to underperform when compared to the S&P. Financials. This is another area that we're keeping an eye on. It's a little bit of a concern. Now you look at this chart and it's doing okay all by itself, and it's in an uptrend. It's a little bit above its 50-day moving average. This seems to be building up an area of support. Where it's a concern is when we do a ratio with the S&P. And going back to about the beginning of May, this is when we saw this ratio start to come down. It held at its 200-day moving average, bounced up off of that, and then broke down below it. Is this some kind of a warning sign? We don't know. But the market is really showing us that the financial sector, even though it's fine all by itself, is really underperforming when compared to the broader market. And so we just want to watch this and see if that ends up leading to something. Then industrials, which are in an uptrend as well and holding up a bit better here, and coming down with the ratio lately, but still in a longer term uptrend when compared to the S&P. Tech, this is the main growth area, setting a new all-time high on Friday, and one of the stronger areas and outperforming when compared to the S&P. Staples, which continue to go sideways, even though they kind of broke out above their 50-day moving average, but in a downtrend and underperforming when compared to the S&P. Real estate, which interest rates go up, real estate goes down. Interest rates go down, real estate goes up. We're trying to generate a golden cross here, but when you compare it to the S&P, this still just really continues to underperform. Utilities, which are holding up quite well. It could be a growth area, could be a defensive area, and looking pretty solid here. And starting to improve with the ratio. It had been coming down, not enough to generate a death cross here because we bounced back above both the moving averages. We'll see if this continues to fall or if it starts to go back up. Then healthcare, which is a defensive area and a downtrend, dropping further below its 50-day moving average and also underperforming the S&P. And when this ratio is going up, that means the S&P is outperforming. Well, lately it's been coming back down when we compare it to utilities. And discretionary, which again, it's in an uptrend and it's above its 50-day moving average, but we would like to see this go up a lot more than it's been going up. And it's actually underperforming when compared to the S&P. And stocks, which measures semiconductors, came down to their 50-day moving average and bouncing back up off of that. Here's another look at the semi to tech ratio. I thought I already went through this. We're a little bit concerned about this. We would like to see this ratio going back up. And then we measure semiconductors to the Dow. This ratio has been going back up, but we're still below the blue line. And then a long-term look, and we've been seeing this for quite a while now. This is a weekly chart of the SOX index, and this is a very long-term moving average, a 200-week moving average. This is the very long-term trend, and we're still well above that. Then the Dow Jones Semiconductor Index, not looks like it's just about an all-time closing high here, and that's in an uptrend. Then we look at the intermarket analysis chart, and again, going back to the beginning of May, we've just been going sideways with gold, but it's been holding on to those gains, and it's still the best performing asset in 2025. Then we have stocks in second place. The purple line, those are commodities. And then we have bonds based on price. And then we have oil, which is negative year to date so far. And then the green, that's the dollar, which continues to be the worst performing asset in 2025. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then some correlations, coming back up into the neutral area when we look at the S&P to the dollar. And then we look at the S&P to the 10-year yield. They're having a slight tendency to go in the same direction now, which lately has been up. And then S&P to oil, pretty much right at neutral right now, not really getting any insight there. The tech sector, the 10-year yield, also having a tendency to go up together, which is strange. Usually they tend to go in opposite directions. And then the S&P to the 2-year yield, also pretty strong tendency to go in the same direction. Then some long-term studies here. This is a monthly chart of the NYSE. Even though it's been going sideways lately, we're still above this longer-term moving average, but we're continuing to decline with the Copic curve. And this is another monthly chart. showing how the NYSE is holding up quite well. We've been coming up with the NYSE record high percent index, even though it has been falling back a bit in the latest reading. Then the S&P 500 still above a longer term moving average, and the PPO is advancing as well. That's longer term positive. And then we look at the S&P on top, and then another ratio between stocks and commodities here. So in the short term, stocks are outperforming commodities, but the longer term, when this is going down, that means stocks are underperforming commodities. Then another US to global look here, we're still above the moving average longer term, but the KST continues to decline. And we go through all the things that are positive. And as I said, pretty much everything except the dollar. It, and the new addition to the list was the small caps as measured by the Russell 2000. But all the major indexes that I follow anyway are now in uptrends. Where the only thing, and Bitcoin is also in an uptrend, the only thing that's negative right now is the dollar. And that's actually been helping stocks. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.